you think they might raise interest on excess reserves and the reverse repo rate. While it sounds wonky, people are going to panic if they see that the Fed's raising rates on anything. Explain the significance of that if they do go forward with it.
Yeah, Kelly, it is a bit wonky, to be frank. And really the reason the Fed might do this, and we think it will, is to take some pressure away from the Treasury bill market and in particular money market funds. So to keep things relatively brief, yields have been negative or very close to negative levels for a while. This is a bad situation. It could probably get worse if the Fed doesn't act. So it's a pretty cheap insurance policy. We think the Fed will go ahead with this.
Michael, can you sort of tell people whether all of this liquidity that's pushing those really short-term rates negative, what is that a sign of? A lot of people say it's a sign that there's too much liquidity in the system and that the Fed is going, way too hard in terms of its liquidity injections. Is that true, or are people drawing the wrong conclusions?
We think that's part of it. But the other thing, Kelly, is remember that awful thing, the U.S. debt ceiling? That comes back into play on August 1st. And that means Treasury's got to take its cash balance down dramatically. So the big takeaway is there will be fewer Treasury bills in the market for the next month and a half. And that puts more downward pressure on yields. So it's a combination of lots of liquidity and diminished supply of Treasury bills. Those two things coming together put the Fed in a tough spot.
Wow, that's interesting that it could get even worse, Steve Whiting, before it gets better. So, that's one aspect. There's a lot of different things we might hear today. This is not just, hey, the Fed left rates unchanged, which it's most likely to do. It's, okay, it might raise rates in sort of the sphere that Michael Schumacher is talking about. They have the rate decision itself to decide upon. They have the forward projections, the dots, as we'll call them, over the next couple of hours here. And those projections are seen of a sign of what they really expect to be doing with monetary policy. And the rate hikes themselves, no one's really expecting till about 2023, but they might kind of pull those forward implicitly. So what do you think markets are positioned for?
Well, look, I think markets should and clearly already have been anticipating that the Federal Reserve, if it wants an early warning, right, about just tapering, just slowing the pace of easing. And these technical issues that Michael just mentioned, for example, are not going to determine policy. That it's time to start acknowledging, that a period of time is needed here for us to just cool the pace of easing. That at this pace, if we were to keep adding jobs at this pace, for example, we'd have the unemployment rate back down to the 3.5 level.
Wow.
In about 16 months. And that's if we get the 3.5 million people who have left the labor force back at the same time at this pace. So, we clearly have seen distortions. These are real issues. We've had demand move rapidly from one big part of the economy to another. No supplier could possibly anticipate that. That can generate inflation spikes. This is not really what this is about. It's that going forward, we can't keep crisis level easing going on in a fully recovered economy.
That makes sense, Steve, to everybody. And I think you're a little bit, I read through your notes, you're a little bit in the Paul Tudor Jones camp, which is if the Fed doesn't acknowledge the inflation pressures that are here and that might be coming, put those trades on its lunacy and so forth. Here's the thing, though, that everybody's sitting here wondering. What is going on with the 10-year yield, right? If we were all really concerned that the Fed were behind the curve, the 10-year would already be spiking. I mean, there would, unless they thought, okay, well, they're going to be so far behind, they have to catch up quickly, and that's going to hurt the economy, and that's going to bring down the level of the 10-year. Other speculations as to why it's so low say, same thing we're seeing in all the meme stocks. All this short, these short squeezes, that's happening over in the Treasury market. And this is just a short. So how, given everything that you're describing, for all the people who agree with you, why is the 10-year bond yield where it is?
Let's just keep in mind that global yields are about a full percentage point lower than in the United States, that the Federal Reserve is providing and buying about the equivalent of the entire need for the whole corporate sector in the bond market, that this is a reasonable distortion. But I do think that the Federal Reserve has some credibility. I mean, just in the past month, long-term inflation expectations have dropped 20 basis points because I think markets are more prepared to understand the distortions of the economy that we've just seen.
Shepard Smith here. Thanks for watching CNBC on YouTube.